All right, welcome to our second lecture on the scope of the firm. Last time we were looking at vertical scope or value chain scope. Today we are going to be looking at product scope, or what's sometimes called horizontal scope. The third one is geographic scope, just so that you don't keep, not to keep the suspense going too long here. So we'll talk about the core issues, the motives for diversification, how firms achieve competitive advantage from diversification, corporate strategy this is called sometimes, or at least it relates to corporate strategy. We'll talk about performance issues related to diversification, and what exactly, we're going to talk about two versions of diversification, related and unrelated. A bit of a gray boundary between those two, but we'll discuss that. When we're talking about corporate strategy and the scope of the firm, our objective is still the same. We're trying to get a return on capital that exceeds our cost of capital. So above average profits, economic rents, all those terms mean the same thing. And the two drivers are still those that we have discussed: the external analysis that leads to the industry attractiveness, and the competitive advantage that we have in that industry as a firm. So the two questions we ask when we are diversifying, we go back to our Porter's Five Forces, our PEST analysis, and we say, how attractive is the industry we're thinking about entering, assuming we're not already in it? And do we have, or can we achieve a competitive advantage in this industry? I'm going to apologize, I'm going to be swatting flies around here. My office is right next to our backyard door, and it's evening and I have bugs flying all around me. So if you see me swatting like this, that's what's going on. Diversification strategies, perhaps unsurprisingly, have changed over time. In the mid-20th century, firms were generally less diversified. A single business was the predominant form of business, and as time has gone on, firms have become more diversified as communication technology, transportation technology has allowed for the faster movement of knowledge and people, as management skills have increased, as financial sophistication has increased to allow the management and the financing of larger acquisitions and mergers. All this has led to greater diversification of firm scope over time. The motivations for these have shifted over time as well. At the beginning, the key motivator was simply growth. As we will discuss, this is not necessarily a good motivation for diversification. In fact, it's a very dubious motivation for diversification. A lot of those early mergers or acquisitions weren't profitable. Those early diversification efforts actually destroyed value for the firm. So they switched to at least saying, well, how can we make diversification profitable? Then to how can we create some shareholder value through diversification? And most recently, it's looked at what's called corporate advantage and the issue of synergies. The implications for strategy are listed there as well. I won't go through all of them. In our first lecture, we looked at the way that strategy has developed over time, and you can see that in the bottom row there. We started off with discounted cash flow analysis, multi-divisional structures, corporate planning. Finally, in the 70s and 80s, started talking about economies of scope, not scale, something we'll talk about today, and portfolio planning models. Advances happen in financial theory. When we get to the 1990s, we start looking at transaction costs as determining the boundary of the firm, thanks to Oliver Williamson. The creation of shareholder logic, the core competence of the parent company. And then finally, more recently, there's a lot of talk about parenting advantage, what's called real options, which I won't talk about much in this course because it derives from financial options valuations, which I don't think you guys have covered, and is really is beyond the scope of this course. So what are the motivations for diversification? Well, oftentimes the key motivation is simply growth, and this is not necessarily a very good motivation. CEOs like to spend other people's money. We call that an agency problem. When you are managing someone else's, a firm that's owned by someone else, or the resources owned by someone else, it's in your interest as the manager to derive as much utility as you can from someone else's cash, resources, company. So rather than give them back the money or create additional shareholder value, you want to spend their money, and one of the ways that CEOs like to spend lots of money all at once is by acquiring other firms. Growth-seeking diversification, one of the few things that are very well empirically tested across economics, business strategy, and the literature on firm scope is that mergers and acquisitions tend to destroy shareholder value on average. A second motivation, which sounds a bit better, is risk spreading. We're in a really risky industry. Let's say we're in oil and gas. Well, why don't we diversify into something else to protect ourselves from the risk of oil and gas? Well, again, that sounds good, but as the manager, right, you want to keep your job. You want to manage more things at the same time, right? Manage two companies instead of just your one oil and gas company. However, again, here, it doesn't add any value to the shareholders, mostly because of the fact that, well, the shareholder can diversify his or her risk perfectly fine without the help of the CEO. The only case where this is just by trading in the stock market. If I'm your shareholder, if I want to diversify my risk in oil and gas, I don't need you, the CEO, to buy a firm in renewable energy. I can just go buy stock in renewable energy, and I'm probably better served by you, Mr. Gas CEO, oil and gas CEO, just sticking to your knitting and doing what we hired you to do, rather than trying to manage my portfolio for me as the shareholder. Finally, the last one, this is the only good motivation for diversification, is value creation. For this to happen, the way I like to put it is that firm A, sorry, let me get my hands in the camera here, firm A plus firm B together have to equal more than those two companies separately. That's our real definition of adding value through diversification. If the two firms are worth more together than they are apart, we've created value. One of the easiest ways to measure this, or at least to try and measure it, is to see what the market says. When a merger or acquisition is announced, if the stock of the parent company goes up, that means, well, almost at least at that point they've added value, but it also means the market thinks this is going to add some value. Usually when an acquisition is announced, the value of the parent stock goes down, which means their shareholders think this will destroy value, and the value of the target firm that's being acquired goes up. The reason the target firm value goes up is because they're also anticipating that value will be destroyed, but it will be destroyed in their favor because the parent firm is going to probably overpay. And that's how the value gets destroyed, is usually, well, at least initially, most acquisitions, you pay an acquisition premium, it's called, the amount you have to pay over the market stock price per share to get control of the firm. It's called a control premium or an acquisition premium. Usually that's almost always too high. So the firm acquiring overpays for the target firm, value is destroyed there, but also then value can be destroyed later on through poor performance if it reduces the performance of that firm. So Michael Porter came up with 3 tests, our old friend Michael Porter, 3 tests for evaluating diversification decisions. First one, unsurprisingly, as it's Michael Porter, he says the industry must be attractive, i.e. perform a 5 forces analysis or an industry analysis and determine whether this is an industry we actually want to enter. The second one, the cost of entry must not capitalize all future profits. In other words, we mustn't overpay to get into this. If the cost of acquisition for diversification, or even if we may have to make a greenfield investment and start from scratch with a new investment in that industry, we need to, I mean, this can be done by a discounted cash flow analysis. Are we going to eat up all of the future benefits from that initial investment? Finally, there's the better off test. Are there going to be any synergies or any additional competitive advantage from these 2 activities or these 2 industries, the one that we're in and the one that we're diversifying to, being controlled under the same management and ownership? This is the most important test. Sometimes it's possible the industry might not actually be attractive, but maybe you're acquiring a firm that has a very attractive industry. The semiconductor industry isn't particularly attractive, but if you could acquire TSMC at a good price, that might outweigh that one, but you'd still want to look at the final test there, the better off test. Otherwise, your shareholders are better off just buying TSMC stock. The key consideration here when we're talking about synergies now, you guys have probably all heard of this idea of synergies, and it just gets to this same point. Is the sum worth more than, is the whole worth more than the sum of its parts? Is A plus B together worth more than A plus B apart? One of the great things about a great marriage is that you get synergies. You share your costs and expenses, and hopefully you reap additional benefits as well. In terms of firms, so you've heard of economies of scale. Economies of scale arise when you are producing more units, and it implies that you are switching your cost structure from variable costs to fixed costs. And that way you derive economies of scope, because the marginal cost of each additional unit, once you've paid all your fixed costs, decreases in some linear fashion for each additional unit. That's what economies of scale are. They're based. Sometimes it's called operating leverage, the extent to which our fixed costs to variable cost structure is higher, which gives us reduced marginal costs past the break-even point. Look up your management accounting course if you need further clarification there. Economies of scope is different from economies of scale, and make sure you don't confuse them. The idea behind economies of scope is that it's not an issue of fixed cost, variable cost ratio. It's an issue of to what extent can we deploy our existing resources and capabilities to new lines of business that we're diversifying into. So it's not a hard asset accounting economy. It's a intangibles. It's kind of like economies of scale, but from intangible resources and capabilities. Things like brands and technology. I like to use the example of Disney. I think I've mentioned it in this course before. I have a debit card from Chase Bank with Darth Vader on it. Chase Bank will have paid Disney, who owns Star Wars IP, a licensing fee to use that. It costs Disney basically nothing almost to get that additional revenue. So Disney's getting economies of scope from their IP, from their characters, from their brands, from their movie franchises. And Disney does this all the time. Every time they license some new toys, teddies, blankets, clothing, whatever, they're getting economies of scope they're diversifying and using the economies of scope from their intellectual property and brand. Sometimes that can be functional capabilities. So Louis Vuitton Moet Hennessy is a very diversified company that owns multiple companies, including, of course, Louis Vuitton, the handbag luggage manufacturer, Moet, I believe that is a champagne company, and Hennessy is a cognac company. They get economies of scope. Why would it make sense to have these firms under the same umbrella? Well, they're very good at marketing and distribution, and they can use that same marketing and distribution resource and capability across these multiple different lines of business that are otherwise very different at the manufacturing end. Sometimes it's just very good general management skills. This is the example of General Electric, for example. They are a very diversified company. Jack Welch in the late 90s and 2000s really put together a team of management ninjas who were very good at just managing almost any line of business very efficiently, and they derived economies of scope from that. Most managers think they can do that, but they don't. Berkshire Hathaway under Warren Buffett, who's now left the company, that's what they did as well. They would acquire what they thought were undervalued companies and just manage them back up to a level of performance where they could then either keep them and take the cash flows or sell them and exit that way. There are sometimes economies from internalizing transactions as well. You avoid those market costs that we talked about. I'll post a video on transaction costs to Canvas to give you a bit more of an idea there. You can also operate internal capital and labor markets. If you have a large, the bigger your firm is, the larger your pool of labor internally. And if you need to move people from place to place, you have people, you don't need to go out searching the market, paying those transaction costs to a headhunter, and writing an HR contract with a new employee or contracting it externally through some kind of long-term contract. You have people you've tested and tried that you can move around in your company, including to different operations and diversified lines of business. A diversified firm also has better information. That's kind of neither here nor there. Obviously, if you're managing two firms, you have better information than people who aren't the managers of those firms. So that's maybe the only sense where there's the potential to create shareholder value, or arguably not. I think this one's a bit dubious, to be honest. It makes more sense in vertical integration because you already have related activities by definition. What are the empirical findings? Generally speaking, there's no consistent relationship between diversification and performance. There is some evidence of what's called a inverted U-shaped relationship. So to a certain point, as you diversified firms perform better, but when they get too diversified, and sorry, my camera isn't mirroring me here, so I think my finger's going the wrong way. But it starts to trail off, and you get diminishing returns from diversification and start to perform more poorly past an optimal point at the top of that U. However, there's kind of a chicken or egg question here. Is it that diversified firms perform better, or is it that firms perform better have more money to spend on diversifying? And really, it's not clear what the answer is there. That's mentioned in the next one, the question of direction of causation, right? Correlation doesn't equal causation. What kind of diversification is more profitable? Related diversification is generally more profitable. Unrelated diversification, I mean, what does that even mean? The idea here is that related diversification is closer to whatever your core line of business is. Diversifying from cars to SUVs, maybe to motorcycles, is along a continuum. Diversifying from cars into, making t-shirts is further away, or diversifying from cars into hotel ownership is very unrelated. Where do we draw the line? We don't have a clear boundary. So when you guys assess this with your firms, you have to use a bit of subjective judgment. Generally speaking, and for obvious reasons, related diversification is more likely to have economies of scope, by the definition that it's strategically more close to what you're doing in some dimension or other. Types of relatedness. If we're going to talk about related diversification, one of them is operational relatedness. So we can use common resources such as distribution facilities, brands or joint R&D. Disney uses its branding across multiple diversified lines of business, as as we've talked about, theme parks, movies, clothing, you name it. There's a version of it that you can get with a Frozen character or a Moana character. R&D can give operational relatedness. Apple uses probably a lot of the same R&D folk across multiple product lines, iPhone, MacBook, Apple TV, etc. There can also be strategic relatedness. If both of the idea is that you perform a Porter's Five Forces analysis and assume that the dynamics are similar, the way you would manage the firms and the type of strategies you need to be successful are related. If in one industry, if one line of business is competing on cost and the other one is competing on differentiation, that's quite unrelated. It's going to be hard to set targets for those two strategies within the same firm. It mentions the problems of operational relatedness, the fact that economies of scope may actually be dwarfed by the administrative costs of managing more activities. What this tends to look like is a firm acquires another firm and says there's going to be synergies when they announce it. Well, we believe there are synergies. We're going to generate this much more revenues, reduce costs by this much by sharing activities. 5 years later, they divest the acquisition to focus on core business and say that the synergies never materialized. Usually it's because the administrative costs dwarfed the economies of scope, if they were ever there in the first place. Other sources of relatedness, resource allocation. If there's similar size of capital investment, similar time spans of capital investment, similar sources of risk. To get back to my point with mining, I used that in the last example, and it's a similar consideration with vertical integration. If the size of investment, the span of the project, and the sources of risk are very different, it's going to be hard to manage those two businesses under the same top management team. Mining, for example, has very long payback periods, very high capital intensity, and very unique, very risky risk profile. You're not going to manage a mining company the same way you manage a tobacco company, which has very steady growth, very stable risk profile, although it's risky to smokers, obviously, but the industry is well known and very cash flow positive, unlike very consistently and constantly cash flow positive, unlike mining. Mining companies have to have very clean balance sheets. They can't afford to take on much debt because of the cyclicality of the industry. Tobacco firms tend to take on tons of debt because they have very steady cash flows, and it's not cyclical at all. People buy cigarettes almost until they're completely broke, maybe even more cigarettes when the economy is in a downturn. For strategy formulation, you should have similar key success factors so that you can set performance targets in the same way across the two lines of business. Similar stages of the industry life cycle. We haven't talked about the industry life cycle yet in this course. I actually talk about it later. But basically, at the beginning of the industry life cycle, the industry is growing quickly, demand is growing quickly. At maturity, demand is stable, and at decline, demand is shrinking. It is again hard to manage one firm or line of business where demand is growing like crazy, which has its own dynamics, versus another firm where it's in decline or just steady, where you would manage it much differently. In a growth phase of an industry, you're focusing a lot on innovation of product and process. In the mature stage, you're really just focusing on efficiency, trying to do things at a cheaper cost, and oftentimes this looks like a strategic change as well. Similar competitive positions occupied by each business in the industry. Same idea there is the strategic similarity. If we're the low-cost leader in one industry, we probably shouldn't buy a firm where it's a differentiation brand reputation issue, right? If Walmart bought Louis Vuitton, they would have to be managed very differently. You'd also risk degradation of the brand, especially for the differentiated brand. To associate it with a cost leader mixes the messaging, mixes the brand proposition of those two lines of business. Finally, performance management and control. If you have to define targets very differently between the two lines of business, you're going to have trouble. Sometimes this can be managed by just separating, creating a divisional structure, and you manage one division in one way and one in another way. We'll talk about this when we get to innovation, but Google, when they started getting into AI, created a separate division called Alphabet, where it was kind of what's called a skunk works. A skunk works, that term comes from the Rand Corporation. That's what they called their sort of R&D lab, where they had all the crazy ideas that they didn't know what they were going to do with. Nowadays, every firm, well, not every firm, but lots of firms will just call their R&D lab a skunk works, where they have the most innovative products that maybe aren't, but usually a skunk works isn't profitable. It makes a loss, and for that reason, you don't manage it based on profit. Google wasn't expecting to get a profit from AI when they were working on it 10 years ago. As some of those ideas in Alphabet became more profitable, as they became more related to their core line of business, they actually made Alphabet the parent company. So Alphabet, if you look up Google now, it's now a subsidiary of a reporting segment of Alphabet, who is the parent company. And similar timeline horizons for performance target. If you are managing an industry that has long cycles, it's going to be hard to set the same targets for other industries that are more seasonal or quarterly seasonal, right? Retail has seasonal targets that you would set that varies over the year. Mining would have very long project targets related to different stages of project completion over the life of the mine. All right, that's all for related and unrelated diversification, product scope. I'll see you guys next week for our discussion of other topics in business strategy. Have a great rest of your day.